Every great financial empire is built on a foundation of trust. Sometimes that trust is anchored in the physical weight of precious metals, and sometimes it is suspended entirely on the fragile promises of politicians. If you want to understand the terrifying fragility of the global economy today, you must look at the two absolute extremes of the American financial timeline. The transition of the American monetary architecture from the physical rigidity of the 1900 gold reserve to the expansive, debt-leveraged complexity of the 2026 fiscal landscape represents the most significant structural shift in the history of global finance. In 1900, the United States formally anchored its currency to a $1 billion gold stock, establishing a system where the growth of the money supply was physically constrained by the extraction and retention of precious metal. By 2026, this paradigm has been entirely erased. It has been replaced by what macroeconomists call a debt wall, characterized by a $38.9 trillion to $39.6 trillion national debt. In this modern era, value is derived not from metallic reserves, but from the state's desperate ability to refinance trillions of dollars in obligations within a highly volatile interest rate environment. Today, we are going to conduct a comparative forensic audit of these two eras. We will explore the systemic risks inherent in a system where interest payments now rival or exceed primary government functions, such as national defense. We will investigate the legislative foundation of the 1900 gold standard, the mathematical terror of the 2026 debt wall, and the undeniable truth about why central banks are currently hoarding gold at record rates. The pendulum of value is swinging back. Let us open the ledger. To grasp how far we have fallen into the illusion of infinite money, we must first look at the rigid discipline of the past. The enactment of the Gold Standard Act on March 14, 1900, served as the definitive conclusion to decades of political and economic volatility known as the Battle of the Standards. This legislation did not merely define a technical relationship between paper and metal, it established a philosophical mandate for the American economy. The act defined the United States dollar as consisting of exactly 25.8 grains of gold, 9/10 fine. This legally fixed the price of gold at $20.67 per troy ounce, a rate that would remain essentially unchanged for 33 years. But the true power of the act was its restraint on the government. The 1900 Act required the United States Treasury to maintain a minimum reserve of $150 million in gold coin and bullion specifically to ensure the parity of all forms of money. If this reserve fell below a critical threshold of $100 million, the Secretary of the Treasury was legally obligated to restore it to the maximum by borrowing money and issuing bonds. The system imposed an automatic mathematical fiscal constraint on government spending. Because paper currency was redeemable on demand for physical gold, the government simply could not expand the money supply beyond a certain multiple of its physical reserves without risking a devastating run on the Treasury. By 1900, the United States monetary gold stock held by the Treasury was approaching $1 billion. The entire federal budget at the time was roughly $521 million. This meant the gold reserve was nearly double the annual expenditure of the government, representing a ratio of liquidity to debt that is absolutely unthinkable in our contemporary era. The state was forced to live within its physical means, but politicians despise limits. And over the next century, the government executed a series of strategic shocks and legislative pivots that gradually decoupled value from physical assets. The first major shift occurred in 1913 with the Federal Reserve Act, which introduced a more elastic currency system, but still required a 40% gold backing for the newly created Federal Reserve notes. However, the fatal blow to sound money arrived in 1971, when the dollar's final link to gold was completely severed, launching the world into a pure fiat currency experiment. The forensic evidence of this transition is written in the complete devastation of the dollar's purchasing power. Under the gold standard from 1900 to 1914, the average annual inflation rate hovered between 0% and 1%. In stark contrast, the fiat era since 1971 has seen average inflation rates of 4% to 5%, with spikes reaching 15% during crisis periods. As of early 2026, $1 from the year 1900 is equivalent in purchasing power to approximately $38.72. This means that the dollar has lost over 97% of its value since the Gold Standard Act was signed. The cumulative price change of 3,772% reflects a century of rampant monetary expansion that was simply not possible under a metallic regime. Inflation is not an accident of the free market. It is the silent, deliberate tax used by governments to melt away the real value of their massive debts. This century of financial erosion brings us directly to the nightmare of early 2026. We are no longer operating in an environment of fiscal discipline. The United States now operates in a purely fiat environment where the national debt has ascended to unprecedented levels. The debt wall of 2026 refers to a terrifying convergence. The gross federal debt is approaching $39.6 trillion. The Congressional Budget Office projects that federal debt held by the public will reach 101% of the gross domestic product in 2026, moving toward a projected 120% by 2036. But the true crisis is not merely the total amount of debt. The crisis is the brutal pace at which this debt must be rolled over. In 2026, approximately $9.2 trillion to $9.5 trillion in Treasury securities will reach maturity. This massive refinancing requirement is largely because the Treasury intentionally flooded the market with short-term T-bills in recent years, leaving an astonishing 33% of all United States debt with maturity dates under 12 months. When combined with a projected annual budget deficit of $1.9 trillion, the United States Treasury is forced to borrow approximately $11 trillion in gross terms within a single fiscal year. This massive demand for capital is colliding with a brutal reality. The era of 0% interest rates is dead. The benchmark 10-year Treasury yield has anchored around 4.25%. A significant portion of the debt being refinanced today was originally issued during the pandemic era, interest rates between 0.5% and 1.5%. Replacing this old cheap debt with new obligations at over 4% essentially doubles the government's interest burden in real time. When a nation owes $39 trillion, mathematics eventually takes over the steering wheel. We have reached a singularity where the cost of borrowing eclipses the actual functioning of the state. In fiscal year 2025, the interest payments on the national debt totaled $970 billion, officially surpassing the spending on national defense. Interest is now the third largest federal government expenditure behind only Social Security and Medicare. The Congressional Budget Office estimates that net interest payments will reach a staggering $1.8 trillion by 2035. When interest hits these levels, it begins to consume 30 to 40% of the entire federal tax income. This is a mathematically guaranteed doomsday level of bad. The government cannot simply pay this money back. It has only two real choices. The first choice is the honest path, a deflationary crash. The government attempts to repay its debt at fair market rates of 6 to 7%, which would instantly bankrupt the Federal Reserve, trigger a failed Treasury auction, and implode the global financial system. That path is politically impossible. The second choice is the dishonest default, an inflationary melt-up. The central bank implements financial repression by printing trillions of dollars that the open market refuses to buy. They artificially lower interest rates to 3 or 4%, even while real inflation runs at 8 to 10%. This means the government stays solvent at the direct cost of burning its own currency. The dollar is deliberately debased to pay our debts with worthless money. This is the exact same inflationary trap that destroyed the Nifty 50 stocks in the 1970s, causing the market to crash by 50 to 80%. When the official ledger of an empire is mathematically broken, the smartest players in the system do not wait around to be crushed. They quietly return to the ancient rules of wealth. The most profound irony of the 2026 fiscal era is the massive renewed interest in gold by the world's central banks. Central banks are fully aware of the looming debt wall. Over the last 3 years, they have accumulated over 1,000 tons of gold annually, a hoarding rate not seen in decades. According to international assessments, gold has now officially overtaken United States treasuries as the world's dominant reserve asset. As investors flee the collapsing purchasing power of fiat currency, gold prices exploded, reaching an all-time high of $4,379 per ounce in late 2025. The United States Treasury itself still holds approximately 261.5 million fine troy ounces of gold, primarily hidden in deep storage at Fort Knox, Denver, and West Point. But here's the terrifying realization. In the year 1900, the $1 billion gold reserve was theoretically enough to cover a massive portion of the circulating currency. In 2026, even at a market price of over $4,300 per ounce, the total market value of United States gold reserves is roughly $1.12 trillion. That entire hoard of gold would cover less than 3% of the gross federal debt. The leverage cycle has expanded so far beyond physical reality that the collateral backing the system is nothing more than the illusion of future tax revenue. The comparative audit is complete. The $1 billion gold reserve of 1900 and the $38.9 trillion debt wall of 2026 represent two absolute opposite ends of the monetary spectrum. The 1900 system was an era of tangible certainty. The government was forced to operate with discipline because the money was tethered to reality. The 2026 system is an era of sovereign fragility, where the primary risk is a devastating liquidity crunch caused by the state's own desperate refinancing needs. The elasticity gained by abandoning gold has been used entirely to manage crises through the socialization of risk. The government passed the One Big Beautiful Bill Act in 2025, raising the debt ceiling by $5 trillion in a single stroke, providing a short-term sugar high while cementing an utterly unsustainable trajectory. As we navigate 2026, the United States Treasury faces a mathematically guaranteed certainty that the interest on the national debt will consume a verticalizing share of the nation's wealth. For the individual investor, the warning is absolute. You cannot save yourself by holding a currency that the state is legally required to destroy. As the system hits the debt wall, the only assets that will survive are those that cannot be printed, manipulated, or conjured from thin. The wall is approaching. The ledger is open.